Hello and welcome to Crux Investor. Today we speak with Adam Davidson, who's the CEO of Trident Royalties. They're a new royalty company listed on the London Stock Exchange. They're based in Denver. We get into the reasons why that might be the case. If you'd like to hear our thoughts on the conversation and indeed the company itself, you can get those on cruxinvestor.com/club. We can also look at company reports, analysis from market experts from around the world, training videos, and also summaries of other interviews that we have done. Plus, there's a thriving community of investors there sharing their thoughts and ideas with each other. If you go now, there's a 7-day free trial. And of course, we'd like your feedback too. So do give us a like, leave your comments below. And if you want to see what we talked about, take a look in the description below. Hey, Adam, how you doing?
Very good. How are you?
Yeah, lovely. Thanks for joining us. We've not spoken before. We're going to hear another royalty story. We love a royalty story, I have to say. So where are you today? Where are you based?
So I'm based in Denver.
Okay. Listed in London, based in Denver. You got to tell us that story in a minute. Why don't we kick off and give us the 1-minute overview first, and then I'll pick it up from there.
Yeah, sure. Yeah, so the sort of quick spiel on Trident is we're London listed, as you said, royalty company, mining royalty company specifically. We don't dabble in other resources or outside of mining, and we're building a portfolio that's diversified. And I suppose that's really our differentiating factor is we're looking to build a portfolio that's broadly reflective of the sector by commodity. So the ultimate intent is that a shareholder can have a single share of Trident and have exposure to the full suite of mining commodities, almost an index fund-like allocation. Because I think what the precious peers have shown is that the royalty approach in terms of getting your exposure to mining commodities, that resonates with investors. But then sort of the next natural question is what can I hold that gives me exposure to the sector from a royalty perspective, and that's what's lacking, particularly from a growth sort of perspective. So that's what we're building, and off to a good start. We've got precious metals exposure, base metals exposure, and bulk commodity exposure. So we're off to a good start in that regard.
Brilliant. Okay, so I want to talk to you about your business plan. I always talk to people about the business plan, what's going on up here, what you've set out to do. Yeah. You've done a couple of things which seem counterintuitive from the conversations that we've had. One, listed in London. London's not really well known for royalties. Okay, the company that is on there doesn't want to be on there. It wants to list in North America, and most people target precious metals. So you've got to talk us through why you've set out to be counterintuitive in that sense.
Yeah, sure. Yeah, so I think we get the why London question quite a bit, and I suppose it was probably a bit harder to answer when we did our raise and our listing back in June. But hopefully now we're able to point to, London started the year with just one listed royalty company, a mining royalty company. Now it has two. Wheaton has announced that they intend to dual list in London, so they obviously see value there. The Ghanaian government is IPOing their portfolio of gold royalties. They've selected London. Have publicly said they're going to target doing that before the end of the year. So yeah, London started the year with one mining royalty company. Will ostensibly end the year with 4 mining royalty companies. So yeah, clearly not a bad place to exercise the business model. And then from our own perspective, we listed sort of just under 4 months ago. We've announced 5 transactions since that time. We're seeing good liquidity. The share price is up sort of any given day, 40 to 50% from the IPO price. As we announce deals, most importantly, we're seeing a response by the market, both with regards to liquidity and trading of the stock, as well as obviously a price response, which is encouraging. But the liquidity is really the key thing in that regard.
Well, yeah, always. But wasn't the easier path to just do North American, whether it be New York or Canada? It's really well understood. It's much bigger market if you're talking about liquidity, and it's a better understood product from that regard. So why discount it? You're based in Denver.
No, that's right. I think we wanted to differentiate ourselves from the sort of typical precious metals TSX path. I mean, because as you flagged, there's sort of a new one every other month, actually, this year, executing on that strategy. And we recognize that comes with some differences. For example, we'll likely be valued on our cash flow multiples, whereas some of our peers on the TSX, they can get away with having a portfolio of development excitement that they can go out and market, and they'll get good liquidity off the back of that. That's probably not going to be the case for us in London. But equally, we're not buying precious metals royalties paying 1 or 1.1 times NAV. And then expecting to be valued at 1.5 or 2 times NAV. We're buying our producing royalties at sort of 0.6 NAV, and our development stage royalties at 0.1 to 0.3. So if we get valued at 1 times, we're getting a commensurate style uplift. But I think on much sort of sounder fundamental footing.
Okay, so let's take a look at some of the numbers there and some of the leverage that you're discussing. Okay, you raised a little bit of money back in May, $16 million. What did you think that was going to allow you to do? Because if I look at the nature of the portfolio, you're right. You're focusing on some producing assets that you may be picking up cheaply, not so much on exploration. So these are costing you a lot. You're going to need to raise some money quite soon, aren't you?
No, not necessarily. And actually, this is where some of the precious guys have done kind of the hard legwork for us. If you look at sort of Metalla, for example, I think we've raised more than they have, but they use their script, they draw on debt, and it's those sort of things. We got a debt mandate in place with Tribeca. We've deployed some of our capital. We still have a fair amount on the balance sheet. We've also we're obviously cash flow positive as well, so we've got revenue coming in. Next month we'll get our Q3 royalty revenue check. So between the ability to use script, the ability to use the cash we have on hand, revenue, tap into debt, I think we've got all the same tools at our disposal. And as you said, we raised 16 million pounds on the fundraise, and we had 4 in the vehicle to begin with. So of all the new royalty companies, we've actually raised the most. So we've got a good amount of deployable capital to build out the portfolio. Because as you know, it's for a royalty company, it's all about building critical mass, and that means multiple assets so that you're valued as a portfolio, diversified portfolio, rather than just sort of a couple assets that are valued individually.
Okay, so what does critical mass actually mean to you? What do the numbers look like over the next 2-3 years? What do you think you've got to achieve?
Yeah, so that's a question we get a lot, and it's obviously a bit nebulous in terms of what critical mass means. But rather than dodge the question, I'll give you my view. When we cross sort of the 10 million sustainable annual revenue, that's the point where I see the royalty model become self-sustaining, because then you're able to service debt, reasonable cost debt at that level. You're able to sort of replace your royalties as they wind down. You're able to replace them with new royalties. You're able to pay a sustainable dividend. On the portfolio we have at the moment, we see ourselves as sort of being about halfway there. And as I said, still have a lot of cash and potential debt and script to sort of further build out the portfolio. So we're reasonably confident that with the tools we have in hand at the moment, we can cross that threshold and get to sort of the critical mass stage where the model becomes then self-sustaining.
Okay, so if I look at some of the peers that you have judged yourself against in your deck, there are a lot of the precious metal royalty companies in there, yet you're claiming to be different from them. So how do I get a real view of what the potential is here for you guys? Because again, if I look at the one, and I won't name them, other royalty company in the UK who's got a similar strategy to you, it hasn't really worked. They've kind of reached a level, plateaued, and people have lost interest.
Yeah, well, I think in that particular case, it's just a fundamentally different stage in their life cycle. And they both got the blessing and the curse of having a really dominant single asset. So, looking at them and saying, well, they get valued at sort of a premium multiple by being diversified and all that. I think they're actually still on that journey. We're at the stage now where each additional acquisition that we do is one sort of tangible step forward towards having that critical mass or that portfolio diversification, which is what royalty investors are seeking. So I think, in that regard, it's both a good and a bad thing. We're able to point to the precious peers with regards to the business model, because in that regard, we're not breaking new ground in terms of, you start to build up a portfolio, you build up some critical mass, you tap into leverage. And as I said, you sort of build the portfolio to the point where you hit that inflection point. That's all been pretty well proven sort of time and again by the precious metals guys. It's just nobody's done it really from the ground up on the diversified side. So that is, I suppose, where we're breaking new ground. But the proof will be in the pudding, and things like being valued on our cash flow multiples, that sort of thing. That's really going to drive our success. But we've got a wide open opportunity set in that regard. Because when we're looking at opportunities, obviously we've talked to how we're not doing sort of precious metals exclusively. So when you actually just look at our first 2 deals, producing iron ore in Australia, producing copper in Zambia, just falls well and truly outside of the purview of all of our listed peers, even the nominally diversified guys, because well, because of asset size in those two cases. They're, the smallest ticket most of our sort of direct peers have. I think the smallest I've seen our other London listed peer do is 20 million, and our deals are sort of falling in the 5 to 15 range. It's probably our sweet spot. We're not constrained, obviously, in that regard, but yeah, with regards to asset size, commodity, geography, we're just seeing a wide open, relatively non-competitive opportunity set.
Right. Are you a bit nervous about the market at the moment in the sense that there's a lot of other royalty companies coming to market with varying degrees of, differing strategies. You've got a lot of money slushing around where people who perhaps a year ago would have been, when you were deciding whether you wanted to do this or not, I suspect, would have not had that many options. So what do you view your competition as now? Not just necessarily other royalty companies, but other forms of money that your potential clients could go and tap up?
Yeah, no, that's a good question because, as I said, there are new royalty companies sort of sprouting up like weeds, but they're all following the precious TSX kind of route. So we're sort of left scratching our heads, and really that was the genesis for myself and my colleague in Perth was, we were in mining private equity, and the fund we worked at had mining royalties, and for the precious ones, you could toss it out to the TSX listed guys, and they'll fight over it, and they'll pay full value for them. But we were left sort of, there's not a natural holder of all these non-precious ones. So it all sort of circles back to the original strategy and the thesis there. We're seeing, in terms of competition, it isn't the other royalty companies by and large. It's equity for the most part. When the equity markets are open to miners, then then they'll be able to raise money. Without needing to do a royalty. That said, there's a whole huge universe of existing royalties floating out there, and we've acquired quite a few in Australia. You look at a place like that just behind Canada in terms of world's biggest mining jurisdiction, but unlike Canada where there's 20 listed royalty codes, there's 0 at the moment in Australia. So, a market that's sort of ripe for consolidation. But one example of you're not constrained in that regard. And in fact, the precious guys sort of face that issue now with gold is sort of running hot. And do you go out there and print deals at these sort of prices, or do you sit on your hands for 12, 18 months, which is not a fun prospect for a public company? Being diversified, you can be a little bit nimble in that regard. Gold's running hot. We've got some good gold exposure at the moment, so maybe we pivot and look at base metals and battery minerals, and we can be a little bit nimble in that regard and prioritize where we see the most value at any given time.
Okay, because we've seen a little bit of movement in Australia with people like Mavericks selling their royalties, people like Vox picking up other royalties. And if people are selling royalties, they're not usually good royalties, or it costs you a lot of money. So you're not going to compete there. We've spoken to people who have got databases of royalties all around the world, and they're small royalties really in the scheme of things. So how do you think you're going to be able to insert yourself in a market where you're going to perhaps piece together packages, some of which are going to be better than others, just to be able to say, well, we can build up this critical mass? And that's a question that you sort of answered earlier. So how do you do that with the money you've got available and the competition out there, and be credible?
Yeah, sure. I mean, it's a good question. And I think it all does circle back to the strategy. So when you've seen the likes of Mavericks and Metalla vend in packages from miners, Newmont, Pan American, Kinross, Goldfields, nobody's done that on the diversified side yet. So, there's opportunity from both the miners as well as PE and credit funds. There are loads of packages out there that just don't have a natural holder of non-precious royalties. So I think that universe is sort of completely wide open and completely untouched. But even just using the deal we announced last week, which was precious metals in Australia, which very well should have been a very competitive, expensive royalty to acquire. I mean, it sits over the entirety of a plus million ounce deposit, a growing deposit. The company's flagged there 18 to 24 months from production, flagged that a couple months ago. It's sort of a potential takeout target because it's sort of surrounded by mid-tiers producing in the region. If that was in Canada, and it would have been gobbled up, probably years ago. It was held by a private party and would have been paid multiples of what we paid. I mean, the reality is we picked it up because it did fly under the radar of most parties. We were bidding against family offices in Iowa that were looking at us. We paid $5.5 million. So it is a substantive royalty. I mean, we see this thing potentially ramping up to 100,000 ounces a year sort of producer. It's a standalone project in its own right, but it will expand. The company's already stated on the drilling since they've announced their resource that the asset's going to grow. So 100,000 ounces a year, 1.5% NSR. It's a plain vanilla clear royalty, uncapped, sits over the entirety of the project. At spot gold prices, that's $3 million a year in pre-tax revenue. If you sort of say a 10-year life on that, we're repaid within the first couple of years, then 8 years, and all the upside that conveys with that being a royalty. So, I mean, these opportunities are still out there. As I said, if we were fighting for a similar royalty in Nevada, probably wouldn't be in existence anymore, or you'd be paying multiples of what we paid. But in other jurisdictions, if they're available in Australia, then they're certainly available in other jurisdictions outside of Australia as well.
Okay, so I want to come back to that point actually in a second, but I just want to finish off on the whole area of how you package this together. There's a old phrase over here in the UK which says, where there's muck, there's brass. Is it a case of you're playing in an area that very few people want to play in because they don't believe it works? And because you do believe it works, there's going to be less competition, and you've got a chance of making some kind of return, some kind of value creation can be achieved if you do what you do right.
I think it's partially that, and I think it's also, I mean, there's some big market cap companies in the royalty space, but it's easy to lose sight of the fact that if you rewind the clock 10 or 12 years, there'd be two names, maybe three. And so now it's 20, and now that, you've got tens of billions in market cap attributable to those companies, but royalties were born out of North America, precious metals. And unsurprisingly, it's still very North America precious metals focused. So I don't think it naturally means that it doesn't work in other commodities, because I think it does. You can get amazing royalties outside of precious metals, but I think and whether it's us or somebody else, I don't doubt that there will be a plus $1 billion market cap diversified mining royalty company in the near future. So I think the opportunity set's out there. It's just an industry that's still somewhat in its adolescence. It's easy to lose sight of that because there are some big players in the space, but it's still a growing, evolving sort of sector in the mining finance landscape. And actually, places like Australia, the royalties that exist there typically aren't because they're part of mining finance packages funding construction, which is what you see in North America. They typically are assets that were born out of M&A or in the case of the Lake Rebecca royalty that we just acquired, it was from the geologist that pegged that ground 10 plus years ago and held a royalty over it. So it's still an evolving and growing part of the mining finance landscape. But yeah, I don't think that it's necessarily the model has been proven not to work on a diversified basis. I think it just hasn't been tried in the same way that it has for the precious guys in recent years.
But it doesn't help that the precious guys talk the language of spinning out any non-precious metal assets into other projects, because it's diluting their ability to create value with the precious metal components. Okay, so there's a lot of them saying that a lot, and that's a lot of white noise that you're going to come up against, and that's why I'm pushing you on it. I want to understand what your rebuttal is to that. Okay, give me some actual reasons why you think it's going to work.
Well, I think it does come back to the valuations, because I think you've seen it. I mean, if you look at some of our peers, and I won't name them, but if you look at their recent transactions, and they're buying royalties on a loss leading basis and are relying on sort of gold price or line life extensions for upside. That's just a different model from us, and then they can potentially do that because they're getting valued at sort of premium sort of multiples. And I don't expect that we'll be getting valued at sort of 2x or 3x like Wheaton is, but we're buying royalties on sounder fundamentals. As I said, producing royalties at sort of 0.6. So we don't need that. We just need to be valued at sort of a 1x, and we're looking pretty good.
Okay, fine. So it comes down to the math. You mentioned a few minutes ago the Australian project. You think it could get up to 100,000 ounce a year producer. On what basis are you guys qualified to work out what the management of these companies is saying is true?
Well, I mean, it sort of falls back to our experience. I mean, we've obviously got technical backgrounds. We've got a board that's got technical and legal and mining finance backgrounds. So, we've been doing this all for a long time. And as I mentioned, my former employment was in mining finance, so in mining private equity. So this isn't our sort of first rodeo in that regard. And obviously we tap into the right consultants. So, when we looked at the copper royalty in Africa, that's a sediment hosted copper deposit, outside of some sort of legacy mining in Europe. That's sort of the one region of the world that has that specific type of deposit. So you go out to consultants that are experienced in that sort of technical aspects. And but in that sense, we're no different than any other royalty company. You've got your in-house resources, and where needed, you sort of tap into external resources, which is not uncommon.
Yeah, but they don't always get it right. And when you start off, you want to get it right more often than you get it wrong, and you certainly want to get the time and predicting the timing correctly. See, I buy your rationale for the economics in terms of the valuation and so forth, but right now you've got to take lower risk projects on, or projects that are more likely to succeed. So is that, how do you go about identifying them?
Yeah, I mean, part of it is we're prioritizing cash flowing royalties or near term cash flowing royalties. Because our peers in the precious space, those have been well and truly sort of picked over in the precious space. So they're going further down the development cycle. So, but when you're, look at our first royalty, it's operated by a ASX listed major in Australia, existing royalty that is paying and has a history. They've invested 120 million into expanding the asset, so they're allocating capital, which is pushing it down the cost curve. It just ticks all those boxes in a very defensive asset, and it's that kind of profile that obviously is sort of popping up on our register. And because these haven't been tapped into in a meaningful way by competitors, because they're outside precious metals or they're outside North America, that opportunity set is still relatively wide open to us. So yeah, we're able to find opportunities that are defensive in that regard, and specific to the gold asset that you'd asked about. In that case, you're looking at an asset, a very well understood region, the most prolific gold region in the world. I think within 100 Ks of that deposit, there's something like 18 mills, mid-tiers operating. In fact, you can tell in the operator's equity, there's priced in some potential M&A activity, because as that thing gets to a size, it would be potentially attracted to some of the operators in the region to pick it up and treat it through their own plants, which would accelerate obviously the timing of paying on the royalty. Now, we're not banking on that, but it's those sort of factors that you're looking into with regards to how defensive is this asset, and what will the production profile look like? What is the certainty to it coming into production? That sort of thing.
Right. Okay. I know we're in COVID times. Everything's being done online, but you're in Denver. Your market's in London, UK. You've got brokers that you need to speak to encourage and to get over the line in terms of pushing a royalty company, which we're not used to over here. We're just not. Anglo's been banging their head against a brick wall for the last 2 years. I know you've said there will be 4 of you in the market by the end of this year or thereabouts. How much time, money, and effort are you going to spend pushing your story here in London?
Yeah, I mean, as you can imagine, it consumes a large amount of time, because there is a lot of education that needs to be done and getting the name out there. I mean, we're new; we're only 4 months in the game, but I think we're getting the traction. As I said, if you look at our liquidity, we've turned over 15% of the register in 4 months. So you annualize that, and we're actually right alongside the majors and mid tiers in the space. And that's being driven by largely UK retail. So it's getting the name out there. As you said, the other guys getting listed will sort of help in that regard. We have Tamasys as our broker in the UK. We appointed a joint broker and Shard to get them involved as well, to tap into other aspects of the market. We have obviously got a PR firm engaged as well. So we're doing everything you can on that front to get the name out there. And some of it is just going to be a time and proof of concept. You get the deals out there, you revisit with investors, if they decline to get involved early on, once they see the deals you're doing and the response you're getting in the market, we circle back with them, and it's sort of the usual routine in that regard. But I think the early indications are positive in that sense.
What timeline have you given yourself to see if the London market works for you, and what do you do if it doesn't?
Yeah, well, we don't want to do sort of a fixed timeline. I think it's got to be sort of a rolling review. And I think it's something that both management and the board are sort of conscious of. And we're monitoring it closely. And as I said early on, the indications are all positive. If for some reason it starts to move in the other direction, then you have to take action and figure out what you do from there. As you've said, peers have tried dual listing. You can certainly explore that. There's a point where it's value creative, but there's also a point where it can be value destructive if you do that and it's not the right time, and you only get one shot at that. So we're very conscious of that. But our priority now is deploying the capital, building out the portfolio. And if the market doesn't sort of follow it and come along for the ride, then we'll figure out what we need to do next. But as I said, early indications, 4 months in, share price up 50%, market giving us good liquidity. I mean, we're seeing everything we need to see in that regard.
Well, 4 months in, early days, everything's always shiny and new, and people are paying attention, and then the shine wears off. My point is, how much planning have you guys done, or do you think you should do, for a what if scenario, which is it's standard response from the UK with regards to a royalty company, i.e. no one's interested? What are the options?
Yeah, I mean, I think, as I said, we're sort of continually reviewing it. In terms of what we do, we're sort of scratching the surface on would a TSX listing make sense, would an ASX listing make sense, but at the moment, because what you don't want to do is sort of limp onto one of these exchanges as a little junior with sort of modest cash flow. What you want to do is get to the size and scale where when you're doing a dual listing, you're coming on as a plus 100 million market cap company. You've got meaningful revenue, you're paying a dividend, and then you're really making a splash. And then that becomes an accretive exercise for the shareholders of Trident, and that's what we'd be looking to do. We don't want to sort of try to limp in as a bit of an escape. It's got to be something that drives value and makes sense.
Right, and you've obviously got a facility available to you. Are you under any pressure from them as to where you deploy your capital? Are there jurisdictions where you don't get? I kind of get the broad approach in terms of the commodities, but in terms of jurisdictional risk, where you focus?
Yeah, no, we're wide open with regards to jurisdiction, which again is probably a bit of a differentiator from our peers. I mean, they will venture outside of North America, but we'll look more broadly. I mean, and when it comes to the debt facility, it comes down to jurisdiction. Zambia, for example, the copper asset there, Zambia may not register on most investors' sort of mindset in terms of a place they desperately want exposure. But that said, it's a common law country with regards to the way they treat royalties. It can be tied to the 10-minute, survives bankruptcy, all the things you want to see from a royalty perspective. So, and that's the stuff that debt providers will be looking at as well, because they want to understand survivability, obviously in conjunction with the robustness of the asset. So those two things sort of working in conjunction are really what drive that conversation.
Okay, Adam, exciting times for you guys. Best of luck. We do like a royalty story. Yours is different. Nothing wrong with that. I just wanted to try and understand it. So come back on when you've got some more news, hopefully before the end of this year, and let us know how you're getting on.
Absolutely. Yeah, thank you.